Hi, I'm Jenny Brown. Welcome to this week's MFB News. I hope you're all doing really well, that you've had a really good week. The weather's been cracking, hasn't it? And long may it continue, because I'm shortly about to jump in the car and go and spend a weekend in Norfolk with the family and lots of small children. And we all know that breaks over the family in the rain are no fun, so keep your fingers crossed for me. Now, in terms of what we got for you this week, we're going to be covering off our usual lender update in terms of pricing and criteria changes. Interestingly, there's kind of an unintended consequence of the rate rises that we're seeing, which we're also going to go into. Then we're going to just update you on some of the latest statistics in terms of rental income and what the predictions are for the future on that, and also how a potential recession could impact the housing market as well. So lots of great stuff for us this week. Okay, so unlike most mortgage brokers, we at Mortgages for Business have our own internal sourcing system for lenders' criteria and lenders' rates. So we maintain that in-house. Most other brokers, just because of the size of them, they won't be able to afford to do the same kind of thing. They use external companies to do this. So what was interesting, and what will give you a flavour of what's been going on, is that we track 52 lenders at the moment. This is in buy-to-let only. And there are a total number of 2,634 live products that we're tracking. Now, last week we archived 1,557 products and we introduced 1,148 new products. This is just a real kind of indication of how fast things are moving at the moment. Indeed, last week 19 lenders updated their products, so a really busy week in terms of rate changes. And really, I give you that information to give you the scale of what's going on at the moment. So what's actually happened, going into the more granular detail now. So first of all, we have seen in the more kind of high street vanilla end of the market, we've seen rate increases from Barclays, Skipton of up to 26 basis points, Accord of up to 52 basis points, Platform Home Loans, Principality, NatWest, Virgin, Leeds. They increased their rates 3 times last week. The people who maintain our sourcing system were delighted with that. And also Coventry have increased rates by up to 0.5% as well. Now, interestingly, what we saw was the Bank of Ireland, who had pulled all of their 5-year fixed rates, have now reintroduced them. The Leeds have also removed all of their 60% loan-to-value products and haven't reintroduced them. And TSB have also reintroduced a bunch of products in various groups. And by that, what I mean is that they would have, say, a range of products available to 65% with a 995 fee, another range of products to 65% loan-to-value with a 1995 fee, for example. So they're various groups of rate. And what they've also done is simplify their loan to value bands as well. So from now on with TSB, it's literally 0 to 60%, 60 to 75 and 75 to 80% loan to value. Now, on the more specialist end of our lending partners, we have seen rate increases from Paragon, Lambay, Fleet, although interestingly they have just reduced their 80% loan to value products. We've seen Zephyr Home Loans, Foundation Home Loans as well increase their rates, and also Precise Mortgages. Now, one of the things from Precise Mortgages which really kind of sparked my interest in terms of things to discuss with you is that not only have their limited company and individual rates, so when I say they're able to lend on HMOs and multi-units as well, so across the whole piece, have increased by between 0.1 and 0.2%. But what's also happened is that they have adjusted their rental calculation. So they have gone up to using now so 125% or 145% coverage at pay rate plus 2% or 6%, whichever is the highest. So invariably that's going to be probably the 6% mark. So it would have been 125 or 145 at 5.5. They've now increased it to 125 or 145 at 6%. The fallout of this is that means that when applying for a mortgage based on the rental income that you have, you can borrow less per pound of rental income than you could previously. Now, the reason this is interesting is Precise are not the only lender who are making changes like this at the moment. So whether it's lenders increasing the notional stress rate that they would use for doing the rental calculation, or whether it's the fact that you're stressing against the pay rate, so 125% at 3.19%, because the actual interest rates have gone up, that also means the rental calculation moves with it. So the net effect of this is that essentially you can borrow, for some lenders now, less per pound of rental income than you could pre the rates really starting to increase. So I think that's really just another thing to be mindful of. It's kind of an unintended consequence of rates going up. Obviously lenders are just trying to be super responsible here and to keep in mind that if mortgage costs increase, then therefore the power of your rent sort of diminishes in terms of how much it can afford to service on a mortgage. So in terms of the overall position of where that leaves us, so broadly speaking, so in the vanilla end of the market, so an individual looking for a mortgage on a standard property, and let's assume that that individual also has no more than 10 buy-to-let properties as well. Your pricing here, so 2-year fixed rates are now from 1.94%, 5 years from 2.25%, and the most generous rental calculation, and this is quite an outlier actually, is 125% coverage at 2.6%. In the specialist end of the market, so limited companies, HMOs, multi-units and people with more than 10 buy-to-let properties, pricing here now starts from a 2-year fix at 2.44%, 5-year from 2.79%, and the most generous rental calculation here is 125% coverage at 2.79%. So actually, the rental calculations haven't been hurt too badly at the moment, but this is only really starting to feed through now, and I do think this is going to actually escalate quite rapidly over the coming weeks. But also what's very notable here is the cost difference between its sort of individual vanilla pricing and the more specialist pricing. So normally what we say is it's around 1%. So, you know, it's 1% cheaper to buy a property through, you know, your personal name rather than limited company, notwithstanding the tax benefits of using the company. But what we can see here is the pricing, the actual kind of margin, the difference is now really compressed to 0.5%. So at the moment, limited company or specialist lending, should I say, is looking actually much more favourable when lining it up compared to individual standard borrowing. Okay, some interesting stats now from our friends at Zoopla with regards to rents. So they have reported that rental growth has continued to gain momentum in the first quarter of 2022, with rents rising by 11% from last year and surging to a record 14-year high. So the latest Zoopla rental market report, based on new lets agreed, revealed that the average monthly rent climbed to £995 per month from £897 per month a year ago, which is almost a £100 jump and an £88 increase since the start of the pandemic. Now, what they went on to say is that the rate of rental growth has gained momentum across most markets in the last 6 months as the post-pandemic demand surged back into city centre markets and the supply of properties for rent struggled to keep pace, i.e. more and more people are now returning to the cities because, you know, actually life is returning to normal, people are going back to the office. And so we always, you know, expected this to happen. So it's, you know, really reassuring to see that those landlords with the more kind of city-based locations are really going to sort of see the benefit, because these were the guys that were most hardest hit during the pandemic. Now, the rise in asking rents has been particularly acute in the flats market in London. However, despite the strong annual rental growth in London with 15.7% over the last year, it is the southwest where the average rents have risen the most, up by £127 per month compared to March 2020. And this is the bit that I find particularly interesting. The rise in rents is pushing up affordability metrics to 37% of gross income for a single earner and 18.5% for sharers. So that's 37% of gross income, not even net income, for people who are renting on their own, which really just gives you a flavour of how much people are going to be stretched in the coming weeks and months with inflation as well. I just refer back to my previous video where we just sort of outline the fact that actually more and more tenants are falling into arrears, and while obviously the temptation to push rents up is very, very, you know, tempting as a landlord, of course it is, also just bearing in mind the fact that actually people are going to be really stretched financially, and, you know, and this is just a very personal opinion, but actually having a tenant that's able to pay regularly is more important than actually kind of eking out an extra few pounds per month. Now, the other thing that's quite interesting here is that what they're saying is that high levels of demand amid constrained supply is still putting upward pressure on rents, but affordability pressures will mean an easing in price rental growth through the rest of 2022. So what they're now predicting is that rents will continue to rise this year, but at a more modest pace, with UK rental growth excluding London at 4.5% by the end of the year, which is in line with independent forecasts for earnings growth for 2022. They forecast London rental growth to be running at around 3.5% by the end of the year. So still a very much an upward prediction in terms of rental incomes, rental figures, but obviously slowing down later on this year as the affordability piece with the inflation really starts to bite. Now, there is much speculation around about whether we're going to enter a recession, depending on, you know, which news commentary you read and which experts you listen to. But I think it is broadly accepted that the economy will at least remain fairly stagnant for the next 2 to 3 years, and there's going to be an uptick in unemployment. Now, reading through a report recently, the National Institute of Economic and Social Research predicts that in the second half of this year, the UK will meet the standard definition of recession. So that's 2 consecutive quarters of falling GDP. Now, as for housing, some predictions are that the housing industry is going to get caught up in the general downturn, predicting a 1.75% drop in housing investment next year, which is broadly equivalent to the new housing supply. Now, in the latest RICS residential market survey, respondents there are said to be preparing themselves for some market adjustments given the recent rate rises and the pressure on household budgets. Now, there was another new economic forecast from the EY Item Club using the Treasury's model of the economy, and they see house price inflation dropping to 5% in the coming months. After that, according to their forecast, house price inflation will subside to 2 or 3% on average. Now, in terms of what that means to the housing market, so actually if we even see a positive number, I think that's actually really reassuring. But I think it's also widely accepted that the resilience of the housing market is really going to be very much dependent in terms of whether the high levels of inflation that we've seen are kind of a one-off, and the predictions are that actually within the year they'll be on their way back down, or whether they're going to continue for a much more protracted fashion, which will obviously have a much more lasting impact on the housing market. But I think in terms of property prices, again, reading through the predictions, very much the school of thought is that we're not expecting any drops, but obviously a much more, restrained growth over the coming months ahead of us. And that is us for this week. Thank you so much for watching as always. And if you do have any questions, we'd love to hear from you. 0345 345 6788, or have a look at our website, mortgagesforbusiness.co.uk. There is an absolute abundance of information there just waiting to be read. I'm about to hop in the car and shimmy up to Norfolk, so I will wish you a wonderful weekend, have a great week, and I will catch you again next time.